today basically investing in real estate. So one of our single business expenses that a lot of us don't really take into consideration is our income tax bills. And I remember when I first got started in real estate, I started full time in 2013, and I was doing, a decent amount of sales. In 2016, I got named to the NAR 30 under 30. I was a solo agent selling anywhere between 16 to 20 million in homes per year. Didn't have a team or anything. So between that and my investment properties, I was making really good money. And I was paying over six figures in income taxes every single year. And I remember 2016, stroking that check for close to 200 grand and saying to myself, I was like, this is bullshit. This was also around the time when Trump had ran for president the first time. One of the things I kept seeing on the news was he doesn't pay any taxes and he's in real estate. And then I started reading up on it. I was like, I want to know how I can do this too. So as I was reading up on this, I started coming across all this information, how like no real estate investors pay any money in income taxes. So then I started going to all these different seminars, these different events and things like that. And then I came across the guy that, Moa just mentioned, Tom Wheelwright. And Tom Wheelwright, he wrote that book, Tax Free Wealth. And what they basically get into in that book is all the different ways why just investing in real estate, you can legally avoid paying taxes. Not illegally, but legally avoid paying taxes. So that kind of got me started on that, little journey of learning about, hey, what can I do? And then I, was able to get in contact with, real estate CPAs who specialize in real estate and things like that. And right now, up until this day, 2017 is the last year I paid a dime in federal income taxes. So every single year I paid more and more and more money. This past year, I had about $1.5 million in tax deductions from simply just literally investing in real estate. So we'll talk about that. And then I'll also, because I believe in showing receipts, I'll show my taxes up here on the screen in case anybody thinks, I'm bullshitting you guys. So I'll show you what that looks like. So what the K1s look like, what the deductions look like, going back to 2018. 2018, I had about 550,000 worth of tax deductions. And I'll show you what that looks like and how, you guys can do the same thing. So one of the benefits of this as well, I would say, is that this is information that you could share with clients of yours. If you guys want to grow your business even further, if you can just speak the language of a real estate investor, you have no idea how much you can grow your business. Because if anybody here deals with real estate investors, you know that real estate investors typically aren't like, I'll just buy one property and I'll never buy another one. Real estate investors buy one property, they start getting that passive income, they see the appreciation, they do a cash out refi, they get tax-free proceeds from that, and now they're thirsty, now they're hungry, now they're buying more and more and more. So if you can learn how to, properly lay these things out that we're going to explain today to your clients who are, every client you have is a prospective real estate investor. You got to keep that in mind too, because what are most people doing with their money right now? They're throwing it in some IRA, some 401k, some index fund that, over 150-year average is getting no more than 5%. Those are the actual numbers out there. There's a study done tracking the returns over 150 years. The real estate, the stock market compounded returns are only 4.64% on average annually over 150-year span. Real estate is closer to 6.5%, 6.64%. That's if you bought 100% all cash. But keep in mind, when you buy an investment property, you're typically buying with around like 25% down, which means that every 1% it goes up in valuation, that is a return to you of 4%. A simplistic way to explain that is that if I buy $1 million investment property and I put down $250,000, if that property goes up by just $10,000, in other words, 1%, that's $10,000 more in equity I've gained on a $250,000 investment. 10,000 divided by 250,000 is 4%. So for every 1% our real estate goes up in value, if we're putting down just 25%, that's a 4% return to us. So real estate, leveraged real estate, is why real estate as an asset class has, really created more millionaires than any asset class on earth, and it's withstood the test of time. Eventually technology will be able to replace most things. It will never replace the ability of having a roof over your head. So that's why, I'm extremely bullish on real estate. I have, 96% of my net worth tied up in real estate investing. So we'll get into all the different ways you can do it, because if you want to go Airbnb, 2 to 4 family, if you want to invest passively in syndicates, if you want to start your own syndicates to buy apartment complexes, we'll talk about all that stuff here. So let's just get started to begin with, just talking about how do you get these deductions, these massive deductions. And the way that you do that, just to begin with, is just investing in real estate And when you do that, you get deductions from what's called depreciation. So depreciation, people always hear real estate and they think, I want my real estate to appreciate. And it will. But the unique thing about real estate is that it both appreciates and depreciates at the same time. Because the term depreciation is really just something you put down on a sheet of paper. It's a paper loss. Because I could have bought an investment property, and I'll give you guys an example. Right now, we're in the process, just give you a little background on pretty much what I do exclusively now is I own a real estate investment firm, and what we do is we buy apartment complexes. So right now we're in the process of buying a $63 million apartment complex in Houston in the Sugarland area. So if anybody's familiar with Houston. So that complex, we have what's called a cost segregation study done on that property, where you have like an engineering firm come out and they basically imagine taking apart a huge apartment complex as if it was a Lego set. And they take it apart, not physically, but virtually in their minds, take it apart, and they place valuations on all these different things. And what it typically works out to is that about 30% of the purchase price is 100% tax deductible in year one of ownership. So for this property that we're buying for roughly 63 million bucks, we're going to have about a $20 million tax deduction from that property. That then is spread out between ourselves and our investors based on how much people are investing and the percentage of ownership and things like that. So that's one way of accelerating depreciation. Now, if you guys are owning investment properties, what you've likely done, and if you just have an accountant who just is, kind of going through the motions, they're probably just doing what's called straight line depreciation. So straight line depreciation is to take the value of the improvements of the building, they simply divide that by 27.5, and then whatever that number comes out, that's what your deduction is. What you should be doing is you should be doing some form of accelerated depreciation. Right now, the most beneficial form is what's called 100% bonus depreciation, where they take the value of all the improvements of the 5 and 7 year, property that they have different lifespans on them. And that's 100% tax deductible in year one of ownership. Now, I'm giving an example of a $63 million property. You could do this on a $500,000 property that's a 2-family. And this is one of those things, just to begin with here, you don't have to be an expert on this. Like when you're speaking with clients and your clients are looking to find like different ways to maximize their returns or deductions and things like that, just ask them, hey, have you ever thought about doing a cost segregation study? They're probably going to look at you like you have 5 heads and say, what's that? And just say, look, I'll put you in touch with an accountant. They'll explain to you what it is. There's a company that we actually use in Texas. That's where we own most of our property in Texas. That's actually based out in New Jersey. They're called Madison Specs. And they'll do cost seg studies around the country. You call them up, you give them the address of the property and everything like that. They put together a study for you. They give you that study. You hand it over to your accountant. Your accountant uses that as a deduction. Now, on like 2 to 4 families, the deductions amount are going to be lower on a percentage basis. Typically, about 20% of the purchase price is tax deductible in year one of ownership. But just think about that. If you buy a $500,000, let's say 2-family property, and you put down 20%, you put down 100 grand. If you get a deduction that's 20% of the purchase price, you get a tax deduction for $100,000. So $100,000 tax deduction, just to give you some round even numbers here, if you were in just, let's say, the 30% tax bracket, $100,000 tax deduction, that means $30,000 more in your pocket, $30,000 less you have to pay the government in taxes. And that's if you're just in the 30% tax bracket. If we scale those numbers up, you would understand how much more money you would save. So, and this is just like very basic stuff, right? And again, you don't have to be an expert when explaining this to your clients. Just throw the information out there to them and just say, hey, have you ever looked into doing a cost segregation study? And I could promise you, if they've never looked into it, and you put them in touch with a CPA who understands that, if you put them in touch with like a company like Madison Specs who actually does the cost seg studies, when they have that done, they're going to actually think it's illegal. And how do I know this? Because I thought it was illegal when I first did it. I didn't talk about this shit for like 2 years when I first did it, to be honest with you, because I started doing this in 2018 and I went from paying like 200 grand in income tax to zero overnight. And I didn't say anything to anybody. And the reason I didn't do that is because I actually thought it had to be illegal. I was like, there's no way this is legal, because I just went from paying 200 grand to $0 in income taxes. So anyway, after doing it for 2 years and after going to events over and over and over again with Tom Wheelwright and, just top, financial and CPA professionals around the country, I was like, all right, let me start talking about this to people. And this is where I disclose to you that I myself am not a CPA. I myself am not a financial advisor. So everything that I'm telling you today, there are more so examples of myself because I'm allowed to share anecdotes and stuff like that. But you should consult a tax or financial professional before engaging in any of this stuff. Assume that everything I'm saying to you is a lie today. In other words, it's not, but just assume that it is. So anyway, with that being said, these are the basics for depreciation. So 2 takeaways from this slide right here. Number 1, learn about cost segregation. And again, to learn about that, we kind of talked about that already, right? Again, you basically have an engineering firm come out. Do I have them up here? I don't have them up here, but I'll write them up here. I can share their contact with you. The company that everybody around the country uses for the most part, they're called Madison Specs. Madison Specs, they're based out of Lakewood, New Jersey. So the CPA here, and again, some people, I get this question a lot. I have no relationship with the CPA firm. My personal CPA used to work for this firm. My personal CPA unfortunately doesn't have the wherewithal to take on new clients now, but he told me, hey, my previous coworker, Kevin, he's a really good guy that I would recommend, people use. So to be honest, I've actually never met Kevin in person, but I do trust my CPA when he refers people to me. So he says Kevin specializes in real estate taxes as well. I know a number of people who have used him and have had good experiences with him. So if you need a CPA who has, good knowledge on real estate taxes, I was told that this CPA is a good one. So take that for what that's worth here. So, and then, here's where it's so unique to us in this room here. The tax deductions that we're allowed to take as full-time real estate professionals, they're different than the tax deductions that other people can take. As full-time real estate professionals, our losses that we generate from depreciation, we can use against our ordinary income. So for example, we can use it against things like our commission checks. We can use it against things like that, money that we're making from our investment properties from the income generated. We can use it against the capital events. When I say capital events, if you sell an investment property that you bought for 200 and you sold it for 350, you made 150 grand on that, you're gonna have to pay capital gains taxes on that. But again, if we invest in these deals, we get these deductions, we can use these deductions against those gains, against that income generated from the real estate investment properties that we do own during the duration of the hold as well. So again, the super unique thing for us about as us being full-time real estate professionals is that our commission checks you guys make from selling, all the homes you sell and everything like that, rentals that you do and all that kind of stuff, these deductions that we generate from our investment properties, we can use against commission checks and things of that sort because we're full-time real estate professionals. Now, what does the IRS definition of full-time real estate professional mean? That means you work 750 hours, not a week, but a year in real estate. Some of you sometimes might feel like you work 750 hours a week. 750 hours a year, which is a whopping 15 hours per week. I can guarantee you there's some of you, if not all of you in this room, who have had some days in this business where you've worked 15 hours a day, right? So again, you have to work 15 hours per week in real estate, and over 50% of your income generated comes from your real estate activities. In that case, you're deemed to be a full-time real estate professional. And then if you're a full-time real estate professional, even your passive losses turn into active losses. Now, what's an example of a passive loss? So when I first started investing in these like apartment complexes through syndicate structures, I was investing in them passively, just as a limited partner. When I was doing that for like, typically if I invested 100,000 into a deal, I was getting like a $75,000 tax deduction. I'll show you what that looks like in a little bit here. That $75,000 loss that I was getting back on a K1, which is a tax document that you get back, I was able to use against my income generated from like selling homes, from the income generated on that property. I was able to use that against all of that. And therefore, again, I was able to wipe out all of my income and pay $0 in federal income taxes. So, and again, this is just from simply investing in real estate. It's not that complicated. It's just investing in real estate and you get these deductions here. And here's a really unique thing. Only one spouse has to be a full-time real estate professional if you guys are filing jointly to use these deductions against your combined income. And the example I always give here is, let's say that somebody's a full-time real estate professional making $100,000 and your spouse is a surgeon making $900,000 and combined you make $1 million. Well, if you guys invest in an investment property and let's say hypothetically you get $300,000 in deductions, your new taxable income is not $1 million, it's 700,000. So if you guys combined in that case are in like the 40% tax bracket, 40% of a $300,000 deduction is 120. You just saved $120,000 in taxes. So that's not a little bit of money. That's a lot of money. That's 6 figures worth of money, right? So, and to share one example with you, I'm not telling any secrets here when I say the market's been insane, the real estate market the past few years, right? So in 2019, the 2018 tax year, I'll show you this in a little bit, I saved about $200,000 in income taxes. That's $200,000 that I otherwise would have paid to the government. I took that money and I invested that in a property that me and my partners bought in the Phoenix market out in Arizona. Now, if anybody knows the market out there, that market went even crazier than you could even imagine, here going. So that $200,000 investment is now worth about $900,000. So in essence, just from the tax savings, because remember, with this tax savings, you can do anything you want with it. You can go on vacation, you could spend it on stupid shit. For me, at least, I just decided to invest in real estate. That $200,000 I would have paid the government, I did not have to pay the government. I now invest that in real estate, and it turned into $900,000. So I could have been out 200, now up 900. It's a net gain to me of 1.1 million over a 3-year time frame. We bought that property in February 2019. We bought it for 11 million, and we got a BPO recently for 34 million on the property. So I'm being a little conservative in that $900,000 number too. It's probably worth a little bit more than that, but that's just to really express to you and show you that, hey, these tax savings, you don't just spend the money, just reinvest the money and grow your wealth with it. So that's just one simple example, and I'll show you the example of that in a little bit here. And here's the thing, like this past year, I had about $1.5 million in losses from my real estate investments on those properties. I didn't make over 1.5 million in money. So any additional, let's say hypothetically, I made $1 million. That would mean I have $500,000 worth of losses that I can carry forward. And I can carry that forward indefinitely. I can carry that forward up to, forever. Let's say I wanted to use those in 2050. I could use those in 2050 if I wanted to. So nothing says I have to use it right away. So I can carry that forward indefinitely as long as I want. So keep in mind that these losses, you don't have to use them all in 1 year. And hypothetically, if I made X amount of dollars and I said, you know what, I'm okay with paying taxes if I made 50,000 this year, because I'm going to save some losses for next year, because I don't know what position I'll be in next year. You can do that too. The autonomy is fully in your hands. So if you want to use it all at once, you can use it all at once. If you want to spread it out, you can spread it out. It's totally and completely up to you. And here's the example, because let's see. There we go. So I said with this, I would go back to 2018. As I said, 2017 was the last year I paid federal income taxes. These are some investments that I made in 2018. They'll come in and out here, but you won't be able to see these. So I'll just fast forward a little bit. So in total, just to kind of recap this, I invested $725,000 worth of my own money into deals in 2018. And when I say this, I also want to preface this by saying, you don't have to have that much money to invest. You could just invest 50,000, 75,000, 100,000, any number that you want to invest in real estate, you can do. You'll just get these at a different scale. Typically, on average, based on leverage and things like that, whatever money is actually coming out of your pocket, typically about 75% of that is going to be 100% tax deductible. If we take into consideration what like your down payment is, the deduction based off purchase price and things like that. So I'll show you what that looks like on these next documents here. This is just examples, like as an example here, you don't just invest in the deals for the tax breaks. And that's why I put this up here specifically. These are examples of like cash flow distribution checks, that we had gotten on these deals here. And I say this to you because any deal that you invest in, the deal could be an absolute dog of a deal. It could be the worst deal on earth. You're still getting the tax benefit. It could be a great deal. You're still getting the tax benefit. So whether it's a horrible deal or a great deal, you're still getting the tax benefit. So don't just invest in these deals because you're like, it's the end of the year, I need losses, let me just dump my money into a deal. Don't dump your money into any deal. Put your money into good deals, because whether it's a good deal or a bad deal, you're still getting the tax deduction in that case. So these are examples of like cash flow distribution checks on those deals. So that year, and this is 2018, I had about $10,000 of passive income from my real estate investments. But this is the important stuff here. These are what's called K1s. These are my actual taxes. I just blanked out my social security number here. So hopefully, yeah. So, but yeah. So with that being said, these are like actually what these documents look like. So these here are called K1s. So when you invest in different deals, like, let's say, like these are from syndicates that I invested in. Just to explain what a syndicate is, it's a partnership on steroids. That's all it is. So let's say it's a partnership between three people. This is a partnership between maybe like 100 people. You'll have like 3 general partners kind of putting the deal together, and they bring on like, let's say 97 limited partners or passive investors in the deal. These were K1s that I had gotten back. These numbers are a little bit small up here, so I'll have a recap slide, and I could share all these slides with you guys, by the way. So just to show you what this looks like, I'll get to the recap slide here in a second. That year, 2018, I had about $556,000 worth of tax deductions. So as long as I did not make over $556,000 worth of taxes, I was going to pay $0 in federal income tax that year. Now that year, I did not make over $556,000, in money. So I therefore paid $0 in federal income tax. Now, again, let's take into consideration that if we just use, again, a number of 30%, let's say somebody was in the 30% tax bracket, in this case, 30% of about 550 is somewhere in the vicinity of like $160,000. If we use 40%, it's over $200,000. So my tax savings this year was over $200,000 less that I had to pay the government in taxes simply because all I did was invest in real estate. There was nothing more to it. All I did was invest in real estate. I got these tax deductions here. So what did that, kind of ultimately turn into? Again, as I said earlier, that turned into me investing in that property in Arizona. I was able to, put 200 grand more into that deal than I otherwise would have invested in because I saved $200,000 in taxes. I would have normally had $200,000 sitting in like a money market account or a savings account ready to write that check to the government. I didn't have to do that year. So what I did is I dumped this money into a deal, and dump's probably the wrong word because that's probably not the right word to use, but I invested the money into that deal. And again, that 200 has over the course of 3 years turned into about $900,000. I'll show you an example of that property and also just explaining to you like the way to force appreciation on investment properties, because you could be turnkey investors, but if you're a turnkey investor, you're just kind of hoping that things go well. And, right now, again, the fundamentals of investment properties cannot be any better. This is like the golden age of investment properties because we have, a huge, the largest demographic patch ever of all time of 28 to 34-year-olds in world history right now or in the US. We have the most 28 to 34-year-olds ever of all time of anywhere in the world in the US right now. That's peak household formation age. This is all while we have an undersupply of housing, both, again, rental properties and sale properties as well. So that's why the rents are growing extremely high. The July numbers just came out. July rent growth month over month was 0.8%, which over the course of a year is about 10% rent growth. Now people will look at that and say, yeah, but last year was like, 1.3% month over month. Okay, so 1.3% month over month is the equivalent of like a 16% annualized rent growth, whereas 0.8% is 10%. That's still pretty damn good, right? And when you take into consideration how you can force the appreciation, we'll see what I mean by that in a second here. So this here is just the very basics of being able to explain to clients how they can force the appreciation of an asset. We call it forcing appreciation because ourselves, like when I buy investment properties, I would consider ourselves to be what we call like light value add investors. What a light value add investor is, we like going in, spending not a ton of money. We're not doing gut renos, but we're going to be spending about $10,000 on interiors, do renovations, doing things like putting in, vinyl plank floors. They actually use these same floors in a lot of our apartments. We'll use floors like this. We'll do, we'll put backsplashes up. We'll resurface countertops, sometimes put in quartz countertops, new kitchen appliance package, gooseneck faucet on our sinks, new vanity in the bathroom, reglazing tubs, maybe replacing the tubs, low flow toilets, because if we can save money on water, that goes right to the bottom line. And take this into consideration. What I'm about to say, you're gonna say that's insane. I've never heard that. If you're in a 5% cap rate market, and what cap rate is just taking your net operating income divided by the sales price. Right now, like in North Jersey and most towns, we're around like for instance, in Hoboken, you might be like 3.5% cap rate, 3% cap rate. But normal, I would say, is about 5% cap rate. If we assume a 5% cap rate, every dollar that you raise rent per month, multiply that times 240, and that's the increase in value to the property. So let me say that again. In a 5% cap rate market, every dollar that you raise rent per month will increase the value of the property 240 times. It sounds insane. Let me explain this, right? So $1 per month is $12 a year. And if you want to find the value of any investment property, you take, again, I have it up here. You take the net operating income divided by the cap rate. So if you want to figure out what is the increase in value, if we have $12 annual increase in value, that's $1 per month, $12 annual increase in value, divided by a 5% cap rate, that's going to give you what? $240 increase in value. Every dollar you raise rent per month, multiply that times 240, and that is the increase in valuation of the property. I know it sounds insane, but that is investment property. So if you ever have friends, I know friends will say to me right now, if you guys have friends, that are renting and you're like, my landlord's insane. They're raising my rent by, $500 a month. I have friends that live in the Rivington and Hoboken, and their rent on their 2 bedrooms going from 32 to 44, but they're not blinking because they looked around and said, we can't get anything for a better deal. So we're just going to renew at this number. But again, in a case like that, let's just use $100. If you just raise rent by $100 a month, that in case is $1,200 a year divided by a 5% cap rate. That is a increase in valuation on that property of $24,000. I could have just done 100 times 240 and that would give me the same number, right? So every dollar that you increase rent per month, just multiply that times 240, that's your increase in valuation. So that, if you can explain this to your prospective clients or even just yourselves who are looking to buy investment properties, when you think about it that way, you start to understand why investment properties, really the values just explode just by doing really little things. If you can save $1 on expenses, if you can raise revenue by $1, every dollar in income that is gained on that property, multiplied times 240, I'm talking on a monthly basis, multiplied times 240, and that's the increase in valuation. It's an insane concept, but it's a true concept. It's a concept when you explain it to people, they look at you like you have 5 heads. I have friends who I tell all the time, they're like, hey, what do you think about investing in real estate? I always am putting data out there about, investment real estate, why, you should be investing in real estate and stuff like that. And they'll say, yeah, but isn't the market like really high now? Isn't it really hot? If you actually dive into the numbers, like the market you guys might think is unhealthy. This is one of the healthiest real estate markets we've ever been in, which is probably, and you guys probably think I'm crazy for saying that. But it's healthy because when you look at the household disposable income as a percentage of debt service and stuff like that, we're still near all-time lows. People can't wrap their heads around the fact that there's a lot of people out there that just happen to have a lot of money. And there's a huge demand and there's an undersupply. And all this business is supply and demand. Really, a lot of what life is supply and demand, right? So, but if you can explain just these simple concepts to your clients, you're going to have a lot more clients who are looking to invest in real estate. Because when they look and they see, and I'll send you another set of slides if you guys want. There's a study that was done from 1870 to 2015, about 150 years, tracking the returns from real estate versus stock market, compounded returns, which equates for volatility, because there's some years when the stock market goes up, it goes down. When it accounts for volatility, again, the 150-year average of the stock market is only 4.64% annually. That's not high. That's not a lot. Real estate, if you don't even at all, if you buy it 100% all cash, it's 6.5. But as I said, we know that typically you're going to buy with about 25% down on average. So you just multiply that number times 4. And in other words, it means roughly about a 26% average annualized return in real estate just from appreciation alone. Has nothing to do with the income generated on the property, just from appreciation. Forget about the income for a second. Forget about the tax benefits, just from appreciation. You're lapping, the stock market like 5-6 times. That's how much more, you can make in real estate. So, but again, if you can just explain this stuff to clients, it'll go a really long way. So again, to find the value of anything, any investment property, you take the net operating income divided by the cap rate. If you want to figure out, you're showing a client a place, right? Let's say you're showing a client a 2-family and you're like, hey, this 2-family, each unit's rented for $1,800 a month. The comp around the corner is identical, same layout, same everything. They're renting for $2,300 a month. And what they've done is, I estimate they've spent about $15,000 per unit in renovations. So if you do that, you'll be able to raise the rents by $500 a month, let's say hypothetically. And they say, okay, well, that's $6,000 a year. That means I probably have to hold it for about 2.5 years to get my money back for it to make sense. You don't, because as soon as you get a tenant in there paying that new price of $2,300 a month, the value's gone up immediately. Immediately, the value's gone up because now you have that rent roll in place. You have the income statement in place for the property, and your value's gone up immediately in this case now. So that's what people don't understand. People think sometimes, but I only want to hold it for a year or two, and that's not going to make sense because if I can only increase rents, and if I'm spending $30,000 and I'm only going to increase rents by $8,000 a year, I got to hold it for like 3.5 years to make sense. No, because they don't have the investor mindset. They're thinking as if I need to make my money back that I spent. You're going to make your money back and then some. Because think about it. If you spend, in my example here, you spend $15,000 per unit, that's $30,000 total. And if you can raise the rents on each unit from $1,800 to $2,300, that's an extra $1,000 a month, $12,000 a year. 12,000 a year to 5% cap rate, we do 12,000 divided by 5, which comes out to $240,000. You're spending 30,000 and you've turned that into 240,000. If you told anybody today that, hey, if you give me $30,000, I'll give you an opportunity and you just have to spend 30,000, that's going to turn into 240, and you'll be able to do that over the course of 6 months. They would say, what's a catch? What's a scam? Are you trying to like pump some kind of crazy cryptocurrency or something like that, right? No, it's just real estate. Real estate is just boring, it's simple, and that's why it doesn't make sense to people, as crazy as that sounds, because it sounds too simple to be true. It's just not, just that's what it is. It's just real estate. So it's so simplistic, but a lot of people can't wrap their heads around it. And then next year, I don't need to get into this. You guys all kind of know why people invest in real estate. I'm not going to waste your time on this. Obviously, passive income, appreciation, tax benefits. One thing I do want to talk about here, though, is number 4, your net effective returns when you invest in real estate. So with your net effective returns when you invest in real estate, typically your bare minimum year 1 return when you invest in real estate is 40% of your money. If we're assuming a 25% down payment, here's how. So you have cash flow, you have appreciation, and you have tax deductions. So let's just assume a 5% what we call cash on cash return. So cash on cash return is the cash that you receive divided by the cash that you invest in. So as an example, if I, let's say, put down $100,000 to buy a $400,000 investment property, and that year I just pocket $5,000 in free cash flow, that's a 5% cash on cash return. That's a super, super conservative number. That's not a crazy number at all. I'm not even, some people would say that sounds too low. Yes, I get it. But I'm trying to be super conservative with these numbers. So that's 5% right there. The appreciation we talked about earlier. The annual number on that for 150 years has been about 6.5%. Let's cut that roughly in half to, let's just say 3%. 3% increase in value. If we assume we put down 25%, we just multiply that number times 4, and that's our return. So if we have just a 3% increase in value, that's a 12% return to us. In a simplistic example, if I buy an investment property for $1 million and I put down 25%, that's $250,000 down, right? If it goes up by 3% in value, I've gained 30,000 in value, 30,000 in equity, because 30,000 is 3% of $1 million. 30,000 divided by 250 gives you 12%. 12% return right there. So we have 5% cash flow. Now we have 12% from the appreciation. Now, taking it a step further, the tax benefit, right? The tax benefit. Typically, for about 75% of my investment amount, the money that comes out of my pocket is going to be tax deductible, as you guys saw earlier. On those K1s I was showing you, typically for $100,000, I was getting around a $75,000 tax deduction. So let's assume a $75,000 tax deduction on my $100,000 investment to buy this property here. So now in this case, I have a $75,000 tax deduction. If we just assume a 30% tax rate, 30% of 75,000 is 22,500. So 22,500 is 22.5% of 100,000, my initial investment. So I have 5% cash flow. I have 12% from the appreciation. That right there is 17% by itself. And then 22.5% from the depreciation for the tax benefit. That's 39.5%. And we didn't even get into principal pay down on the loan, because money's going to be, used on your monthly payments, paid on the principal, and that goes towards it too. So like your floor return in year 1 when you buy an investment property is 40%. 40%. And again, if you tell people this, they think you're insane. They think you're crazy. Because if you told somebody, everybody's so used to the stock market and bullshit like that, where they hear 8% on average over the years. It's actually lower than that. Financial advisors will tell you it's 10%. They're full of shit, right? So 8%, others will tell you who are trying to be more truthful. They might be genuine, but they actually don't take into consideration the volatility. The real number is close to 5%, right? So again, 40% real estate, 5% if you're in the stock market. It just doesn't make sense, right? You have so many people, so many friends, so many family members who they're doing the boring thing. And some of you, and I don't say this to chastise anybody, but some of you are probably doing the same thing. You've been told growing up, invest money in a 401k, IRA, all that kind of stuff, and just let it grow. Another thing people don't realize, you can take money from your IRA and 401k and invest it in real estate. People don't know that. So for example, I had money in an IRA. I used the money I had in my IRA. I sold all the stocks in that IRA and I invested in real estate. I invested passively in real estate syndicates where I was getting these returns in these syndicates. I could have had that money invested in Apple Computer, but now I have that money invested in, Avaya Sugarland, which is an apartment complex in Sugarland, Texas, in Houston, right? So again, you could use that money. I'm not telling you have to get out of your IRA 401k, but you can use that money in your IRA 401k to invest in real estate. The only drawback of that, and I'll just tell you this, if you do use money in an IRA 401k, you don't get the tax benefits, unfortunately. You'll get good returns, but you don't get the tax benefits because an IRA is almost viewed as like an individual person. So anything that happens with that stays in that, and you're like a separate person entity from that IRA. That's the only drawback of that. But again, you can use IRA 401k funds to invest in real estate as well. So keep that in mind. And with this here, so they talk about, kind of some of the exit strategies. When I say they, I mean me. So by the exit strategies here, there's a lot of different ways that you can exit real estate. Here's my personal, if it was always up to me, here's how I would do it. So any investment property that I own personally by myself, and if the decision was always up to me, I would never sell. I'd hold them forever. And instead what I would do is cash out refis. Anybody know what a cash out refi is or familiar with that? So with a cash out refi, what you're basically doing is, let's say I bought an investment property for $1 million. And after a number of years, I've raised the rents, I've raised the incomes and things like that. And after a few years, that investment property now is worth $1.2 million, right? I've gained $200,000 in equity. Most lenders will allow you to do a cash out refi at 70% leverage, 70% loan to value ratio. Some will actually allow you to go higher, but let's just use 70%. 70% of that $200,000 is going to be it's going to be $160,000. Is that right? 160,000. Yeah. 140. Yeah. $140,000. So I'll be able to pull 140,000 in equity out of that property. Now here's the beauty of this. That 140,000 worth of equity I take out of that property, that's tax free. Refi proceeds, loan proceeds, always tax free. Why? Because you got to pay that money back to the bank eventually. So for that reason, it's not a taxable event. So I do a cash out refi. I take that 140. Let's just round it up for easy numbers' sake and say it's 150. Now, with that 150, if I use that to put down 25% buy another investment property, I could buy a $600,000 investment property. Now, then when that one goes up in value and the other ones go up in value, keep doing cash out refis, keep getting tax-free proceeds. When I get those tax-free proceeds, I buy more investment properties and you slowly kind of build like an empire, right? So, and again, it's not going to all happen overnight, right? Real estate is like the slow, boring game. A lot of people, it's not the sexy, exciting, thing that people want to have happen, right? You don't make all this money like right overnight. But again, you could really build huge amounts of wealth. And if you keep doing these cash out refis, here's the other good thing. Let's say I bought an investment property when I was 30 years old and I bought it for $500,000. And I'm going to live till I'm 100, right? So when I'm 170 years down the road, that $500,000 property that I bought 70 years ago, that is now worth, let's say, $4 million 70 years later, which again is probably even low for the rate of appreciation over the course of 70 years. But if I were to sell that prior to death, they would do $4 million minus $500,000 my basis, and I have to pay a capital gain of $3.5 million. So what do? You buy, borrow, die. Anybody ever hear that term, buy, borrow, die? What they mean by that is you constantly do cash out refis against that property. You hold them forever. You die, you leave them to your kids. What do your kids get? You get a step up in basis. Their basis on that property now becomes a fair market value at time of death, which means when your kids inherit this property 70 years down the road, they get a $4 million property. Their basis is $4 million. Hopefully they're not complete and total shitheads and they want to actually keep the property and not just sell it and fire sale and go on vacations and stuff like that. But let's say they do want to sell it right away and do whatever they want to do with that. If they do sell it right away, 4 million minus 4 million is zero. Their taxable capital gain on that is $0. That's what they mean when they say buy, borrow, die. Constantly do cash out refis. Because if you do sell, you will pay a capital gains tax. It's granted a long-term rate, which will be 0, 15, or 20%, depending upon your tax rate. So I guess that's the worst case scenario. You've essentially lowered your net effective tax rate from whatever it is currently down to 0, 15, or 20%. But you can just do a cash out refi instead. Still hold that property, still generate income on that property. And by generating income on that property, you keep padding your pocket and you go out and you buy more investment properties. And you keep doing it over and over and over again. And you can do it forever. Nothing would stop you from doing this forever, right? You also do a 1031 exchange. So with a 1031 exchange, I sell one of my investment properties. And within 45 days, I have to identify the replacement. And within 180, I have to close on If you're ever a 1031 buyer, number one, never tell anybody you're a 1031 buyer because you lose every bit of leverage that you have in any transaction. Because if you find anything in the inspection, they'll say, I'm not touching anything. And you'll say, you have to touch this. That's insane not to touch this. And they'll be like, yeah, go ahead, pay the tax on the 1031. So don't ever tell anybody you're a 1031 buyer, right? Number two, make sure, especially in a market like we're in right now, you have that property lined up for the 1031 before you even go through with it. Because right now we know that it's, it's gotten easier to get properties, but it's still not easy to get properties, right? So make sure you have that property lined up, because in those first 45 days after selling what's called the relinquished property, the one that I'm selling, I have to identify the replacement. I'm allowed to identify up to 3. Of the 3 that I identify, I got to close on one of them within 180 days. So make sure you have that lined up before you even sell the one that you're selling. And make sure, obviously, that you don't do this by yourself. Hire, somebody who specializes in 1031 exchanges, like an attorney, or a QI, qualified intermediary who specializes in these, because things need to be filed properly. If you don't file them properly, you'll get hit with the tax bill. So if you're going to do that, make sure you do it, the right way, I would say. And again, there's a lot of different ways this could be accomplished. Just to give you some background on how I, kind of started this. So I started, when I first started investing in real estate, I bought a couple of condos in Hoboken, actually, and I put them on Airbnb. And the reason I did that is I grew up in Essex County, and me and my friends would take cabs into Hoboken to go out on the weekends. We were all living at our parents' house still. And when we were doing this in like 2012, 13-ish, we'd take cabs back home. And we always said to ourselves, there's no hotels to stay out here besides the W. And at the time, we did not have money to stay at the W. So we couldn't stay there. That was like $400, $500 a night or something like that. And there was nowhere else to stay. So we would just go back. And I said, you know what? Once I started making some money, I said, let me buy some condos and I'll put them on Airbnb. Now, I did it the wrong way, just to be honest about it, because I was self-managing these. I was like, I can do it all, take care of it all. So when you're running an Airbnb, you're running like a hotel, basically. So you got to go in when somebody gets out. You got to clean the place up, hope they didn't destroy it. And the final straw for me, I rented it out to a group of young individuals on New Year's Eve 2015, going into 2016. And I came back the next day, and I don't know how this can happen. And granted, the toilet did still work, but the toilet was turned like 45 degrees the other way. It should be 90 degrees the other way. So the toilet normally faced here. It was now facing here. And I was like, oh my God. And there was nothing anywhere. So I was just very confused by it. I flushed it, it still worked. And I moved it back, and I was like, oh shit. So, but anyway, that was the last time that I ever did that. And then I sold those off and everything like that. And then I was doing subdivisions and flips. Subdivisions are huge opportunities that I think a lot of people pass up. Not that they pass up knowingly, unknowingly. If you ever like driving through a neighborhood and you see an empty lot, I just get out of my car and I ring both neighbors' doorbells. And I say, hey, you know who owns that lot next door? I'm hoping that one of them owns it, because if one of them owns it, it's a subdivision opportunity. If some person bought it years ago, they just done nothing with it, it's not really an opportunity for me, unless I can get it hooked up with a builder who will build on it and sell it, right? So what I would do with those is, one of these, the most recent one I did was like 2-3 years ago now at this point, but it was a lot that was 100 by 160. Every lot in that neighborhood was like 50 by 110. So this was like a slam dunk. What happened was, what I found out is this woman had passed away, and she had originally bought 2 lots, hoping that her kids would build a home next to her. It never happened. So she combined them into one. So they called me out, and because I was on top of them after, she had passed away. I'm not what I would call like a grave chaser by any means, but at the same time, I usually stay on top of people. I don't read the obituary to see who recently died. I do know people who do that, and they actually do well with that, though, believe it or not. So, but anyway, with that being said, I followed up. They called me out to the house. They wanted me to list it. And I said, have you guys thought about subdividing this? And that's usually how I get into it. People always think subdivisions are really, really complicated. And maybe in some areas they are. But if you have a slam dunk one like that, just take it yourself. So they said, no, it's a lot of work. And in my head, I'm like, okay, this is a perfect opportunity. So I said, well, I'd be interested in just buying this off you myself. Obviously, private sale, no commission, no nothing. What would you want for it? So they told me, threw a number out there. Long story short, we settled at 410. What I did then is I chopped into 2 separate lots. I sold the one lot off for 225. I put about 100 into the house. I flipped that for 600. I made like 275 over the course of like 6 months on that. So they're simple, they're easy. And all you have to do, if you're in a town that you're not like familiar with, go through the town's meeting minutes and go to the planning and zoning board And you'll be able to see the same engineer's name pop up and land use attorney's name pop up over and over again for every subdivision application in that town. Most likely, they're probably friends with the people on the subdivision board. And that's more important than them being smart, to be honest with you. So you get hooked up with those people who know exactly what the planning and zoning board wants. You hire them, they take care of everything for you. You sit back, the neighbors come and complains and they don't want a new house built. You don't even react. You just sit there and you let them do all the talking, you let them bury themselves and they approve it and you make money. So I did those two, but when I was doing all these things, obviously they're a little bit more transactional and a little bit more time consuming. So starting in about 2015, I started passively investing into those syndicates I was talking about earlier. So all they really are just large partnerships, where basically what you're doing is you're having a whole group of people buying like an apartment complex. Now you can syndicate anything. If you guys wanted to buy self-storage facilities, mobile home parks, apartment complexes, you can syndicate anything. A good example of a bad syndicate is Fire Festival. If anybody remembers that Netflix show, right? That's a very bad syndicate. A good example of a good syndicate would be something like an apartment, complex syndicate, right? So there's different examples of that. So you could literally syndicate anything you want to syndicate. So with that being said, I started passively investing those in 2015 because at the time, when I was doing these Airbnb, really the New Year's Eve Airbnb thing was my last straw. So I said, I need to find something that's just more passive, right? So I started passively investing in those and about, late 2018 to 2019 to the present day today. What I do mostly, probably about 80% of my time is occupied on we buy apartment complexes, me and my two partners, and we're the general partners on the syndicates now. So again, as I just said earlier, all they really are, they're just large partnerships. So we might buy a property where it's like, let's say a $63 million purchase, and it's me and my two partners, and we might bring on, let's say 150, limited partners, right? And typically the returns you see on those deals are very, pretty similar to what you would get in like a 2 to 4 family. It's just you do no work. So when I started doing that passively, I liked that because I just kind of had my money work for me. But as time went on and I started kind of transitioning more towards the GP side and dedicating more of my time and efforts there, that side is more time consuming. So whether you guys want to invest in syndicates as an LP or start one of your own as a GP, you guys can do that. Anybody can do it. So just to share with you kind of my experience with it, I found the value of being I didn't have to start obviously as a limited partner, but the benefit I found from that is I wanted to find really good operators who were doing them and just learn off them by investing my money in their deals. Because by investing in their deals, I was getting these monthly reports of the financials, kind of a summary of what's going on. And I had a line to them. I had a connection to them. I could call them up and ask them questions. So the way I viewed it is I wanted to invest in good deals, but then also learn along the way. That's why I started off as a limited partner, not as a general partner. And I was investing in deals in LP for about 4 years before, kind of moving over to that GP side. You guys could do it any which way you want. That's how I viewed it, at least. And I think that was beneficial for me because you learn some things that you don't want to learn while you're in control. So as a limited partner, it was cool to kind of experience what happens when there's a big fire at a property. Number one, the first concern is that everybody's safe, right? So I invested as an LP in a deal in San Antonio in 2016. And one of the buildings there, 24 units of the 309 total, had a fire, an electrical fire, and it ripped through the entire building. The building was destroyed, uninhabitable. Number one, everybody was safe. That was the first concern, right? Number two, what is the first call you make? I didn't know this, but Red Cross, the Red Cross actually provides 3 nights worth of housing for anybody who's placed by a fire, food and accommodations and things like that. So that was a learning experience. Number two, different types of insurance that you need on your investment property. So loss of business income insurance, debris removal insurance, which I never thought of. You need to get debris removal insurance because otherwise you'll get the proceeds to rebuild it, but not to tear it down. And that's expensive, right? So debris removal insurance, code upgrade insurance, because what the insurance companies will typically try to do is just say, yeah, this was built in 75. We're going to give you the money that basically a 1975 build needs. Well, the code today in 75 is not the same. So code upgrade insurance, replacement cost insurance, right? You want to be able to replace this with today's expenses, with today's costs and things like that. And number 5, making sure that you hire your own adjuster, because the insurance company will send out their adjuster. And as you would imagine, do they want to give you more money or less money? Less money. So you hire your own adjuster and it's going to cost you a few $1,000, but you'll get, enormously more proceeds. I'm talking 6 figures, sometimes 7 figures more worth of proceeds in that case. So those are some of the things that I kind of learned, along the way with that, along with a bunch of other things, because you start to see like what's going good, what's going bad, where are the problems typically popping up. So I was able to kind of see that along the way. And these are some examples of, what these look like. One of the things I want to show you, remember I said earlier, like you spend a little bit of money as a light value add investor on interiors and what that can do to raise the value of the property. The example I'm going to show you now is a property that we bought in Phoenix or Glendale, technically back in 2019. And it was all 2 and 3 bedrooms. The 2 bedrooms, when we first bought it, they were going for about $850 a month. The 2 bedrooms now are going for about $1,500. The 3 bedrooms are going for about $1,050. They're now going for about $1,750 on this property here. So to show you, this is just real quick, just to go over this. The current market value of $100,000 investment is about $450 on this. Again, let me also be transparent in saying this. That's not just because we're such good investors. That's because the market's such a good market, right? So now we did well ourselves. We managed it good, but anybody who tells you that they can, create this type of return in such a short period of time and it's all because of them, well, run away from them because they're selling you a bill of goods, right? So anyway, long story short, cash on cash, you'll see people talk about that. If you ever look at any of these deals, what does that mean? That's the cash that you make divided by the cash you invested. So when I say right now we have a 12% cash on this deal, that means that if somebody put 100,000 in, they're getting back about $12,000 a year in cash flow. Average annualized return, we originally thought that we'd get 17% on this deal. Typically, we'll target deals that get between like 17 to 20% annually. We're obviously way ahead of that because the market's been so good. We're close to like 150% average annualized right now, due to how good the market's been. So you'll hear them talk about like average annualized return, and about $100,000 investment got about an $80,000 tax deduction on this deal. So about 80% of people's investment amount was tax deductible. So here's what I mean when I talk about like light value add. This is what it looked like when we first bought it on the interiors. And we only spent $4,600 for the after picture. So this is the before, this is the after, and that cost $4,600. Now, granted, we did that in 2019 and things have gotten more expensive. Today, this probably would cost us closer to $6,000, $6,500, somewhere in that ballpark. But all we did here, we put in these vinyl plank floors, which are pretty almost identical to these floors, print wise. So we put in these vinyl plank floors, we resurfaced the countertops. We didn't put quartz in. So when we talk about resurfacing countertops, there's companies that come in, they put down this like a epoxy finish, and you can make it look any way you want. We wanted to make it look like, white marble. So what they do is they put down this epoxy with they put the gray veins in it and stuff like that. It looks like marble, but it's not. And that's good because when you have a tenant move out, if they've destroyed, if they've been really, really rough on, the counters and the kitchens and stuff like that, you can kind of just create like a new countertop. So we resurfaced the countertops, not this unit, but some we put in backsplashes, this gooseneck faucet, new lighting fixtures, new kitchen appliance package. So we got these kitchen appliances. There's a vendor actually out there in Phoenix. I forget the exact name of it, but there's one in Jersey called Dings and Things. And Dings and Things sells brand new appliances that just have dings in them. In other words, they were taken off the truck and they hit something and they have a little dent in them. So you can kind of, it's not clear enough here, but there's a little dent right there. So for that, you get this 60% off. So we bought a huge package of these, right? So new kitchen appliance package. And again, we were able to make the place look a lot neater, cleaner, and nicer, and ultimately raise rents based off of this. That's an example of a interior. This one, Ventana at Valwood, this is a property we have in Dallas, North Dallas, in Farmers Branch. This, I'll show you an example of the exterior. Now, you see the date we bought this. We closed on this one, February 22nd, 2020. What happened 3 weeks later? Everything shut down. So we were freaking out. We're like, we're going to lose everything, right? The country literally shut down. So anyway, everything worked out really well on here. It just delayed our business plan a little bit because our plan was to do kind of the same thing we did in Phoenix. Go in, spend money on doing interior upgrades, raise the rents on that. That was delayed by about, 4 or 5 months. But we were lucky to be able to go in week one. We had it all lined up. We use this company called Save Water Co. in Texas. What they do is they come in and they do water conservation for you because back then in 2020, Fannie and Freddie, we have a Fannie Mae loan on this property. Fannie and Freddie had a green program. And this green program, what they did is if you were a green investor, which is a bullshit term for saying you're going to do some water stuff to make it pretend like you're doing green stuff, they'll give you a 25 basis point discount on the loan. So this water stuff that we did is we replaced the toilets with low flow toilets. We put in new aerators on sinks and low flow shower heads. Now that was good because this was an all bills paid property. And obviously, when coronavirus struck, everybody stayed home. So our water expenses would have gone through the roof if we had like those still like enormous toilets that flush like 6 gallons every time they flush. So by doing that, we saved probably around like $50,000, which again at a 5% cap rate is $1 million in valuation. So it's not, a little bit of money. That's a lot of money, right? So again, for this year, just to show you what the exterior looked like. I have two partners. One lives in Houston, one lives in Dallas. And when we first bought this, my partner in Dallas, he's like, hey, fly down. He's like, we got, a property I really like. He's like, you saw the financials, come and see it now. So I said, okay, I'm down in Dallas and Houston like once, twice a month. But when I first pulled up this property, my immediate thought was it looks like an outdoor jail. Because if you look at this right here, it was like yellow with like round doors. It looked like shit. So I said to him, I said, hey, what's the plan here? Because this looks like, people are going off to like a jail. He was like, oh, we're going to spruce it up and everything like that. So we did that. We do this a lot on our exteriors because we want to have good curb appeal. This is a property on South Josie Lane, which is actually a pretty busy street over there. So you have good frontage, which is good for an apartment complex, for kind of accessibility purposes. So able to spruce this up. We got this done, because you were allowed to do exterior work even when things were shut down. And Texas opened up pretty quick too. Just to be honest, Texas was kind of back up and running by June. So anyway, we got all this done. So that was good on the exteriors. We don't need to really get into all the details of syndicates here and stuff like this. These are slides that I use. I teach a C class on with the state on syndicates, where we go through all the different types of syndicates like 506B, 506C, things like that. If you're curious, I can send you over these slides, obviously, and all that kind of stuff. But as I said, basically all a syndicate is, it's just like a very large partnership. So again, you're going to have maybe 3 general partners who are, putting together the deals, searching out deals, and then they bring on limited partners, and everybody shares in the appreciation of the asset. They share in the passive income of the asset from cash flow distributions, and also the tax benefits as well, obviously. So anyway, we'll get into some of this in a little bit. We don't have to get into the details on this here now, though. There's different documents that you kind of sign along with these, just to go over these real quick. So if you guys ever look into syndicates, these are the 3 documents that we call them the sponsors, the general partners, will give you. PPMs offering operating agreement and subscription agreement. So the PPM just lays out everything bad that can happen. So I remember the first deal I invested in 2015, I read it and I said, well, this looks like anything. Basically, it lays out, it says a tornado can happen, this can happen, like the property can get hit by a nuclear bomb and stuff like that. It lays out like the worst case scenario of everything. That's kind of like the way I always liken that too, is if you watch TV late at night and the commercial comes on with a magic pill, but at the end the fast voice comes on and says, well, you might go deaf, blind, get killed or die, right? So again, like that's like what the PPM is, that's its purpose. The operating agreement tells you what the general partners can and cannot do without your permission, and subscription agreement is how much are you going to invest. That's basically what it is. One thing that I'll share with you, if anybody looks into these types of deals, if you guys go to events where people are there and they're trying to syndicate deals and look for investors, here's the number one question you should always ask them. What's the most recent deal you did? And then follow it up with, how's it doing? They're always going to say, it's doing so great, it's wonderful. Okay, so what's the most recent deal you did? How's it doing? And if they say it's doing so great, it's wonderful. Okay, can I see your most recent monthly report along with your original webinar when you guys were, giving out the projections on that deal? In other words, what I'm trying to see is, what did you say it was going to do versus what actually happened in real time? And if they say to you, well, I can't share that with you, that's private information, they're lying. I know they're lying because I do this all the time. I share these with, our investors who invest in our deals and say, hey, if you have any questions, here's our webinar from the last deal that we did, and here's our most recent monthly report from that deal that we did as well. So you can take a look at this, and if you have any questions, let me know. There's no law that says it's illegal to share that information. So if they tell you they can't share that with you, they're lying to you. They're telling you that they can't share it with you because the deal's probably not doing as well as they said it was going to do. Right? That's the number one question. Now, as far as like my investment criteria, I have like macro and micro criteria. So like my macro criteria, I like landlord and business friendly states. I like areas that have population growth, wage growth, economic growth, good diversity of employment base. What I mean by that is I don't want the whole area dominated by one sector. I don't want like it just to be military as an example, just to be, oil as an example, things like that. That's why actually, if you look to buy any investment properties next to a military base, they'll give you a lot lower leverage. They usually make you put down like 50% because their thought process is if that military base leaves New Jersey and goes to Georgia overnight, you might lose 50% of your tenants overnight. it's a much riskier loan to make. It's not because they don't like the military, it's because the risk that is implied by having an over concentration of one source of employment in that area. Then a micro criteria, if I look at my investment portfolio, my properties that are within walking distance to supermarkets and pharmacies always perform the best. They have the highest occupancy, they have the least turnover, and also the ones that are within walking distance to a good school. Because good schools usually implies that you have more families in the community. When you have more families, they typically don't like to bounce their kids around to different schools every single year. So they renew at a higher rate. And when they renew at a higher rate, they stay longer and your collections are higher ultimately at the end of the day. So that's like kind of the micro versus macro criteria there. And then, as I said, like there's some different questions you asked, but if I could just share one question with you for you to ask them, again, it's the question I just mentioned. What's the most recent deal you did? Can I see how's it doing? Because you just want to, I just like hearing them say it's doing so great, just so I can ask them, okay, so can I see your webinar you did for the deal in your most recent monthly report? So that is the number one question by far that you can ask. So that's how I kind of found these. I was going to these events and I would start going to these events where they were geared towards syndicators. And I would start asking people, hey, other than yourself, because everybody's only going to say myself, other than yourself, who's somebody that you recently invested with, you had a good experience? And if the same name kept popping up, I would say, oh, it was he or she here. And, again, in that case, I would find that person, I'd get on their investment list. And after I got on their investment list, I would then, we call it the distribution list. I would get their emails saying, hey, we have a new deal we're raising equity for. Here's what it is, blah, blah, blah. And then I'd say, okay, I looked it over and I'd go over their most recent monthly report and the past deal. Looks good. Let me get into this one. That's how I did it personally. So, and again, I could share all these slides with you. So if you guys, do look into these deals and you want to know what questions to ask, these are the questions that I ask people before I invest in their deals here. And then this here is just my contact info. So if you guys want me to send you these slides, I could certainly do that. My email is just my name. It's kylekovats@gmail.com. You can just write in the subject line, hey, send me the slides from today. I'd be happy to share those with you. And again, as I said, so as I was introduced earlier, so I do own Kovats Real Estate School. We're in North Jersey. Yes, Paul, right? Yep. Yeah, I can not forget Paul. I remember one time you came back from Miami on a trip and you said, hey, I might be dozing off today. So,
I remember everybody used to be dressed up. I was coming after trucking all day.
Yeah.
One day I was up to you. I was like, no, I don't think I'm gonna do this. And you said to me, look, the only person I'm not worried about is you.
Yeah. Yeah. So I knew I was happy to see you here today. So but yeah, never forget Paul. I see thousands of people through there, but Paul is a memorable person. So with that being said, yeah. So if you guys ever know anybody looking to get licensed, we'd certainly appreciate it if you consider sending them to us.
Everybody.
Yeah, I appreciate it. And yeah, so as I said earlier, the only thing I really do now for the most part, besides have the real estate school, is we do put together syndicates, me and my partners. So if you guys we only for the most part do like Dallas and Houston. So if you guys are ever interested in investing in one of those deals, you could certainly email me and say, hey, put me on your distribution list. I'll try my best to get you guys in the deals. We have openings in them. We just are about to close out a deal now, but we're hoping to maybe get one by the end of the year, ideally next year or something like that. So I can certainly keep you guys in mind for that as well. So yes.
So when I look to do cost segregation on my properties, I was told that pretty much the analysis overweighed my deduction. So I just did straight line.
Okay.
What's the average cost of a cost segregation?
Yeah. So that
Or
depends. Yeah, so about $2,800 typically. And it's worthwhile. And the reason I say that is because let's say you have like a 2-3 family that's worth 500 grand, you're probably going to get a deduction around like 100,000 on that. So you're not the only one who's told me that, because I've had a lot of people tell me that. Who told you that specifically?
Well, I mean, when I started looking at the tax strategies, I learned about it. I was like, oh, this is great. And then I started kind of quoting it out, and I was told it was just not announced. Like I think 3 different places from investors that I talked to, and then from like YouTubers that I would follow about.
Yeah, you know what? I was down in Austin 3 weeks ago. I got another, I got to find this I'll get it for you, but just email me. I got another company that does it for like $500 too.
That's nuts.
Yeah, but again, if it's like a 500 grand property, even if you get like a $50,000 deduction, hypothetically, it should be higher than that. But even if it's 50, I mean, if you could spend, let's say 2,000, get a $50,000 deduction, it's well worth it.
Yeah, the way it was made out to be is like you have to fly the person out, and they have to do this whole analysis, and it's like a 2-family house, and it doesn't make sense.
Yeah.
Because the money doesn't outweigh what you think on it.
Yeah.
It's straight line everything now.
Yeah, again, that company, in that case, because not every company actually physically goes to the property,
Right.
just to be
Yeah,
honest
it
with you.
doesn't- yeah,
They
that's
might
just-
say they do, but they don't. So, with that being said, if it is a company that needs to go to the property, that company in New Jersey, they're within driving distance. They're right by the shore. So in Lakewood, so they'd be able to come out to you. Yeah, so I'll share that. I'll share both contacts with you. I got to get the other one, who I think is actually based in Arizona, but still, even if they can do them virtually, it's worthwhile.
Sure.
Definitely. Anybody have any questions on anything that we talked about here? Any general questions on anything? Yes.
So when you started your first project, how big was the project itself? Like how many units?
The
Or
first
what would
syndicate
you
that we
say-
did,
Right.
yeah, so it was 3.9 million. It was 69 units in Fort Worth, Texas. Yeah, so, and that one, we only raised about $1 million in equity on that. Yeah, so we did that one in actually 2018 on that one. So at that time, it was our first deal, so we didn't want to do anything like too big. We felt that we would be able to raise, at least $1 million in equity, so we'd have no issue with that. Because you don't want to like tie a deal up, put up like non-refundable earnest money, and then not be able to perform on it and then lose that money. So we started off with that. Now between me and my two partners, we'll do deals where, over the number of years, we've built up a pretty, really big investor database. So we'll do deals now where we can raise like 25 million bucks within like a week. So, but that's obviously it relates to, we've been doing this for a number of years now at this point. And then also we've been able to perform on the deals that we have, brought to our investors previously. But yeah, we started off our first deal, we just raised $1 million on that.
And what type of lenders do you guys typically work with?
So all different types of lenders. Right now, we use a lot of debt funds. So our most recent deal that we're doing, we're getting a loan through Barings, and it's actually the New York City Teachers Pension Fund that is lending us the money. So that's bridge debt. That one's floating rate bridge debt. And the reason for that is because there's no prepayment penalty on those loans. So floating rate, it's our spread is 310 over SOFR. So SOFR kind of tracks the federal funds rate. So we essentially turn it into a fixed rate loan because we buy a rate cap. We'll buy a rate cap. So if our spread is 310 over SOFR, we'll buy a rate cap at, let's say, 1.9%, which means that our highest interest rate can ever go is 5% on that, as an example. Yeah.
So you use that as leverage as bridge loan.
Yeah. So a bridge loan typically is, we call it 3-1-1. So it's 3 years, and then you could extend it for a fourth and a fifth if need be. So we typically do go bridge debt. To give you an example, we have a property, the property in Phoenix here, and I showed you, that now is worth a lot of money, right? Our loan on that is about 9.5 million bucks. And last year, we were thinking about selling, our prepayment penalty on it was going to be $3 million. So that's, if you get fixed rate debt for like typical term is 10, 12 year, 30-year amortization schedule. So you're paying it back, so you borrow the money over 30, and at the end of year 10, you have a big balloon payment due. But you get hit with a huge prepayment penalty if you sell prior to maturation of the loan. That's why we typically opt to go bridge and essentially turn it into fixed by buying the rate cap. Yeah. Because in other words, like if we're taking out a loan for like this deal we're doing right now, $47.5 million loan, if we buy a rate cap that costs us $1.5 million, if we sell in year 3, our prepayment penalty on that would probably be close to like 8 million. So we essentially turn an $8 million prepayment penalty into 1.5 million. Yeah. Anybody else have any questions on anything that we talked about? Yes.
I have a question. What happens if let's say without
Uh-huh.
a certain party wants to take away the stepped up basis? What's the strategy? for that?
So they always try it. Like it
Yeah.
just got tried
Yeah.
relatively recently. It never succeeds though. And the reason is because both parties take advantage of it. So they'll speak a big game, but they won't actually do it.
Yeah.
That's my viewpoint on it. I worried about the same thing because they proposed this last fall, I think it was. And when they did that, I was like, oh shit, I really hope this doesn't go through. And then I talked to my CPA. He was like, look, they talk a big game, but I can tell you for a fact that it's not going to go through. So they floated out there, but it always gets new. Just like the carried interest thing just got killed in this most recent bill. Now there's some bad stuff in that too, but the carried interest thing would have affected real estate returns. Because if you take money from like an investor for you to like buy property, them getting they call it the carried interest loophole, which is just a fancy way for saying we want to redefine the word capital gains. Anyway, they always seem to crush it. So I'm not as concerned about that as I was like a couple years ago. Yeah, just because you see what happened with it. Any other questions, anything that we talked about? And as I said, if you guys ever think of any questions, certainly feel free to reach out to me. As I said, I'm happy to send these slides to you and things of that sort. So I think we have tacos coming in.
Yeah, anybody got anything else? Let's just give Kyle a round of applause. Just so you guys know, too, Kyle has a book, he's modest, so he's not gonna speak on a lot of things. But it's called Middle Class to Multimillionaire.
Yeah.
So if you guys want to pick it up, you guys that are a part of the book club, we're gonna eventually get to it. So we're talking to Kyle about that too, maybe him coming in and speaking for a bit. So he does that have, you know, he has that going on, but Kyle, thank you so much.
Thank you.
The tacos are downstairs from what I know, so we can start filtering down there. And yeah, let's have some lunch.
Perfect. Thank you.